Good evening, everybody, and welcome to EY's webcast on the rate rationalization. We've had a landmark GST Council meeting which concluded a day in advance with significant announcements on the rate rationalization front, which was anticipated over the last several weeks, providing clarity with respect to movement of rates on goods as well as services in addressing duty inversion, amongst others. The announcements also included a wide range of proposed changes to the law as a part of trade facilitation measures as well as certain structural reforms. So in today's webcast, I'm joined by an illustrious panel. I've got with me Vipin Sapra, who leads our tax policy for indirect taxes, who's a familiar face, no doubt, to webcasts from EY. We've got Divyesh Lapsiwala, senior partner based out of Mumbai, who leads our financial services and insurance space for indirect taxes, and Sagar Shah, a partner who leads the Pune practice and focuses and specializes on the automotive and infrastructure sectors. Welcome, gentlemen. And we hope to have an insightful and engaging discussion today on the key announcements of the GST Council. To quickly provide an overview of some of the major announcements, we've had our rates recalibrated. We're moving closer, perhaps, to the originally envisaged single rate regime slowly. From a 4-rate structure, we're moving to a 2-rate structure of 2 standard rates, effectively of 5% and an 18%, with a demerit rate of 40% on certain goods and services. These rates, as announced, will come into effect on the 22nd of September, with the exception of pan masala and certain tobacco products. The current levy of compensation cess will continue only on these tobacco products. With respect to all other products, the rates are getting recalibrated to subsume compensation cess wherever required. On the structural side, I think the much awaited operationalization of the GST Appellate Tribunal is around the corner. The most anticipated amendment to the place of supply rules with respect to the taxation of intermediaries has also been announced. It's been a long-standing ask of the industry in general. And certain changes have been proposed to the way in which GST credit notes can be issued with respect to discounts. More welcome changes in the form of trade facilitation. Our refunds hopefully are going to get faster, along with a more streamlined process through which businesses can get a GST registration. So overall, a very positive outlook and a lot of positive changes as far as both the industry as well as the common man is concerned. If we were to particularly focus on the rates, like I said, we're moving to a 2-rate structure. A lot of goods under the 12% rate have moved down to 5% or proposed to be moved down to 5%, and from 28% to 18%. And the entire thinking seems to be that these rates need to be brought down to ensure that common goods and services, which form a part of the daily expenditure portfolio of the common man, needs to be brought down, increasing affordability, thereby increasing economic activity. And across the board, from food to household items, to apparel, to renewables, to agriculture, to personal care items, to insurance, to accommodation, to smaller sized motor vehicles, there's been a rate reduction. On the other hand, the increase is only with respect to largely sin goods and services, be it tobacco-based products, be it betting, gambling, etc., or carbonated beverages which have a health or a negative health impact. Those have gone up. On the services side, there are some changes to the rates. The 12% as a rate is going away, so it couldn't be maintained. And in some cases, the 12 with ITC has moved to 18 with ITC for certain transport services. But overall, if we were to take a step back, I think the announcements have been great. Definitely, it's going to give a boost to the economic activity. It's largely going to benefit most sectors, subject to perhaps some of them still grappling with inverted tax on account of capex and services. But at least on the goods front, pretty much across the board, the rate reduction and rationalization has ensured that the rate has been brought down not just on the finished goods, but also on the input side on the key raw materials and key components. Now, with this said, I'd like to kind of invite Bipin to provide us with a further overview of the structural reforms and the facilitation measures. Post that, we will go on to nitty-gritties of what is happening on the services front, goods front, and what are some of the impact areas for businesses. Over to you, Bipin.
Thanks, Jayashree. Good afternoon, everyone. I think it's a celebration of sorts for the industry, given the measures which the government has taken, the reforms which the government has announced and delivered on all its promises. I think it's a time when we need to do our bit for the economy and uh, really get the motion on to pass on the benefits and really take advantage of the benefits which the government has given us. Apart from the rate rationalization, a lot of changes were brought in, which may have gone on unnoticed, and that's where we want to bring in and explain the structural reforms which have taken place. Uh, the intermediary services, which have been a major bone of contention when it comes to determining whether the export has taken place or not, have been amended. Let me step back and explain to you. An intermediary is service is defined for the person is a person basically who's is an agent or a person who's facilitating the supply of a good or a service. And essentially, when it comes to major services providing services outside the India, the place of supply becomes India if you are providing the intermediary services. Accordingly, there have been a lot of litigation and the refunds of major ITS companies and the companies in this area were facing huge litigation. In an effort to make export, especially export of services competitive, the concept of intermediary has been removed from um, the definition of Section 13(8)(b) in the IGST Act. And what it means is that any service which was an intermediary where the location of supplier was the place of supply will now be following the default rule and would be treated as an export. That's a huge change and something which the government was committed to do for a long time. Having said that, the second issue which has been there, which is in front of the government for a long time, was on the GST Appellate Tribunal. It's finally been formed. The members have been nominated, have been selected. The officers are in place, and 30th and end of September is the time when they'll start accepting appeals. And the hearings will commence before the end of December 2025. That's a huge change, and it's a very welcome change also. All backlog appeals have to be filed before 30th June 2026, a very relevant date, and a substantial time has been given from here to 2026 June to be able to file these appeals. Another demand of the industry from an ease of doing business perspective is the creation of a National Appellate Authority of Advanced Ruling, and the principal bench of GSTAT in Delhi has been nominated as as a National Appellate Authority for Advanced Ruling. Just to remind you, National Appellate Authority for Advanced Ruling is where there are conflicting orders of various state appellate authorities, and a state or the center goes ahead and files a advance ruling, an appeal against those orders with the National Appellate Authority to reach a point where a uniform practice can be followed or the uniform interpretation of a law can be done on the basis of diverse rulings. Uh, Post-sale discount was something where there were a lot of issues. The classic issue was that given that whenever the post-sale discount was given, the condition that the discount should be known before the transaction happening was not always fulfilled. And there were issues where disputes were being created, the discounts were being denied, or the people who were receiving the discount were being treated as service providers and being demanded GST from them. All that has been settled. Section 34, which allows the issue of a credit note, there a clear condition has been added where giving of a discount has been allowed as a valid reason for the issue of a credit note under GST. Once that has been done, the section 15(3)(b) has been amended to provide that discount granted through a credit note issued under section 37 will be considered as a even if so the condition of knowing the discount prior to the transaction has been done away with, and accordingly if a credit note has been issued under section 34, that itself is a valid ground for allowing the discount. So that settles issues from a perspective of the refund. Similarly, there were issues.
Sorry, if I can just come in there, maybe on the intermediary one first, Bipin. While you explained that on the export front, I think things are looking good. Would it then equally be correct to say that import side, where let's say we have commission agents, brokers outside India, today we're not paying a GST because the place of supply is outside India. As a consequence of this amendment, I guess businesses will now need to equally look at on the import side and see whether there is an additional cash flow or a cost that they need to incur with respect to intermediary services being received from outside India. Any thoughts on that? Because this is really taking away the place of supply differential through the amendment, is it not? It's not just the export side, but we'll have to equally look at the import side of things.
Fully agree with you, Jayashree. The import side will now open up for from a perspective of uh, uh, from a perspective that any commission agent or a procurement agent who's outside India, their supplies to India would be charged under the reverse charge mechanism. The only benefit out here is that in a normal course that will be available as a credit. The export, when intermediary services were charged to GST on the export side, it was always going to be a cost. So that's where the only difference is. That's the difference. I would still suggest that a clear condition should be laid down as to, while a lot of work has been done on intermediary earlier, but from a perspective of what will constitute as a intermediary services outside India, that may need to be clarified, given that a lot of services under the may come under dispute.
Right. And Bipin, the one on the post-sale discount, to my mind, at least I felt it was interesting in terms of the timing of it, because it does give an opportunity, I'm guessing, to industry to pass on rate-related discounts on a post-facto basis through the supply chain, right? Because now we don't need to tie it up. There doesn't have to be a prior establishment of an agreement before the sale, etc. So after rate change, this perhaps is an avenue for industry to pass on discounts through the supply chain to mitigate the rigors of the rate impact on retailers, distributors, etc. But having said that, do we not need a change or an amendment to the law for this to be operationalized, or do we believe that this can be brought in even before an amendment to the law for industry to benefit from this through, let's say, a notification? Any thinking around that that you've picked up on this particular issue?
So while the rule can be amended immediately, the section would need to be amended by way of an act of parliament. So my understanding is, and I haven't had a detailed discussion anywhere, but it should be by way of an amendment in that.
Sure. So while we wait to watch to see how it gets operationalized, because I guess there was an announcement to the effect that they will put in place some process for companies to leverage on this, in the wake of the rate change. Please do continue on the trade facilitation measures.
Okay. Now, a number of trade facilitation measures have been put forward, things which are linked to the major the changes which have been brought in the current reforms. So once with the rate rationalization, a number of these wherever the rates have been reduced, there is a possibility of a large number of IDS or inverted duty structures being created. While they have taken care, while the government has taken care that they try to align the input rates and output rates so that the inverted duty is created to a minimum, or at least it's taken care of. And we see cases in textiles, in cases we see cases in uh, fertilizers where these have been very specifically taken care of. However, inverted duty structures exist and will continue to exist. What they have done is that earlier the provisional grant of refund was only limited to where the services were zero rated, mostly in case of exports. Those there they have added that the inverted duty structure can all refunds arising on account of inverted duty structure would also be eligible for provisional refunds of 90%. There was a requirement that the refunds need to be done a preliminary scrutiny and then granted a refund. That also has been removed, and now there'll be certain parameters based on risk assessment laid down. On the basis of that, there'll be an objective determination whether this provisional refund is available, and if so, there will be a grant of that refund immediately. That's, I think, a grant of that refund to the extent of 90% immediately. So that, I think, is a huge change and would benefit industries across the sectors. The registration has been simplified, and automated registration within 3 days would be given as long as it's an optional simplified scheme. And there the eligibility is that for low risk applicants and applicants who based on their own assessment determine the output liability, and the output liability will not exceed 2.5 lakh per month. So there there would be a simplified registration scheme. Similarly, ECOs, the suppliers who were supplying through the ECOs, example Flipkart, Amazon, there were issues in terms of primary place of business, because most of these people had were the warehouse of that those ECOs were the only places where they were registered, and they were not accepted as principal place of business. So there was an additional cost which was being incurred. That has been done away with, and the principal place of business can be the one premises across India, one place across India, and hence that would be taken care of.
All right,
Back
thanks,
to you,
Vipin.
Jayashree. Yeah.
Thank you, Vipin. So I think Divesh, it'll be great if you can come in. I think there are a lot of questions. While the, extent of changes to services perhaps is not as extensive as what's happened on the goods front, purely in terms of rate change. There are a few significant ones I think a lot of people want to hear us talk about. One, of course, being insurance, the other perhaps hotel, and the last being the local delivery services related amendment that has come through. So if you can take us through these with particular emphasis on what are some of the nuances and considerations businesses need to keep in mind while they transition into the new rate regime. Over to you.
Yeah, thanks a lot, Jayashree. So when I look at these service sector related changes, we can bucket it into two broad categories. One is services that are largely B2B or dominant in B2B, and the others are B2C. B2C, of course, are changes made connected with making the price of goods and services cheaper to the consumer. So we'll come to that. But if you look at the B2B ones, the job work rate reduction and making it efficient, reducing the tax burden on MSME, labor-intensive industries, is a welcome change from 18 to 5%. So even if then your headline rate of the finished product is lower or your margin is less beyond the job work cost, then you're not suffering with the inverted cash flow. So job work rate reduction for B2B is welcome. Similarly, if you see logistics, now in logistics, as for all B2B transactions, logistics was uh, split between 5, 12, and 18. A major part of what was there in 12 now has moved to 18, and therefore the logistics providers broadly have a option of doing 5 or 18. 18 will be with ITC and 5 will be without ITC. So that's the high level view for B2B. But when you come to B2C, and then that B2C spreads across all the three headings, there are certain significant or important aspects which will directly impact businesses operating in that space. So if you talk of insurance, for example, the current the document suggests that all life insurance, whether it is term policies, endowment, or ULIPs, all life insurance is exempt. Of course, this is related to the risk premium or the risk element of the premium that you're paying. So that exemption kicks in from September 22nd. All health insurance is exempt. There is currently a big debate on what is the meaning of health insurance, because whether personal accident policies get covered, whether travel is also a health product and gets covered. So that clarity is awaited. There's no definition of what's a health service. Similarly, both these health and life services are also sold through group platforms. So we understand group services are not covered here because it specifically talks about individual health and individual life. But in many cases, group is used as the chassis to sell insurance, where I'm working with an NBFC who is also helping me sell credit life policies to protect the NBFC's own interest of repayment of the borrowing. And therefore, the term insurance is in the name of the borrower, but the name of the NBFC is also there on the policy because the NBFC is making sure their loans get repaid in an unfortunate event of death of the borrower. So will this become B2B or B2C? Will this be individual insurance or not? Is a massive question. So in in the insurance space, and we will talk about some transition points which are common across, because again, which premium will be liable to tax. In insurance, you have this very unique aspect of premium payment in advance. You have proposal deposits. All of us get premium intimations in advance, and we typically end up paying that. But the risk start date may be after September 22nd. So there will be challenges if you pay, let's say within the 30-day grace period, what happens? If you cancel and rebook, what happens? So the sector is going to deal with a bundle of issues, and each one of us individually also will have to look at these aspects closely. In the logistics space, there are equally B2C providers as they are B2B providers. So for B2C providers, the option now is 5% without ITC or 18% with input tax credit. Question arises as to whether businesses will choose one over the other. So on a stratified basis without any distortion of market influence, if I am a capex driven entity where I have already sweat the asset over a period of time, and therefore I mean, let's say I have assets which are more than 5 years old, I may be okay with 5% without ITC because I would have juiced out most of the the capex cost and the credit in the past. But if I am a operating model entity where I have recently bought assets or I have leased out back to back all the assets, then I may be compelled to do 18% with ITC. So logistics companies which are in B2C space have an important determination to make of the choice of the rate. Having said that, market forces will also play out. We have seen in particular, again, another example of services sector that tour operators have always been allowed 5% without ITC and 18% with ITC. But most tour operators have always aligned to 5% with ITC because of the optics with the consumer of charging 18% versus 5%. So, which is not a GST question, it's a business question. So that's logistics. On hotel accommodation.
Divesh, if I can just come up, I think there are
Yes.
quite a few questions on insurance. I just thought I'll pick them up, as we progress. And,
Yes.
one of the things is what people are asking is, does this exemption apply only to new policies, or can they expect their whatever premiums that they may paying on existing policies for whatever reason, will that get covered as well?
Yeah,
Or
I
are we
think
looking at only new policies?
no, a very important question. And here the answer lies in the way GST looks at insurance as a contract. And it's quite fundamental because that position also influences the transition position. So I'll just take a minute to explain that for insurance as a contract, because of insurance 64 VB provision, you will always receive the premium before the contract starts. Second, insurance companies do not issue any invoices, and therefore policy is the invoice. And third test, which always applies, is provision of service. There is no tax on the provision of insurance. The tax is on the contract of insurance. The insurance period may start from November, but the minute you have billed and collected for insurance today, or if you have issued the policy today, tax liability arises today. So there is a deeming fiction in our law which says that service is deemed to be provided to the extent covered by the invoice, and therefore effectively the policy becomes your reference point. This answers both the questions. One, if I have an old policy where the premiums are becoming due now, what will happen? Because we are saying that these are contracts of continuous supply, and therefore the installments that you agreed in your contract become the time of supply. Each anniversary premium due date will have to be independently tested for determining what is the rate. So if your premium dues are falling after September 22nd, then they should get the benefit. If your due dates were before, then even if it was just 15 days or 1 month, you would struggle to get the benefit, given the fact that the peculiar interpretation that I mentioned. And then connected there to Jayashree is how will you also transition? Because you have the 2x3 test and businesses are now struggling to fix the 2x3, or now sort of two events being together, the invoice as well as provision of service. It is a game of collection and issuance of policy document. So that's how they will have to deal with this. So while we are on logistics, I did want to quickly get into the point of local delivery services, and that's an important change. For this concept of local delivery services is there in the HSN. It is there in HSN 9968, but there is no explanation of what it means. It is just a terminology used. If you go back to the CPC, and initially, as we all recall, there was we had referred to the government had referred to CPC 1 for understanding or interpreting the meaning of local delivery services. So if we of all the services that are being taxed under GST, if you go under heading 68030, local delivery services are defined as this subclass includes local delivery services of items such as food and other purchases, right? And then it says it does not include moving services of furniture, office, courier, etc. So the 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 importance of this, therefore, is whatever is the last mile delivery work that is happening in the economy can get impacted by this particular change of moving local delivery services to 18%. Further, in addition to prescribing 18%, which is always the case, there is a specific exclusion that is provided to say that these services will not get classified under GTA. So you cannot take a goods transport operator classification or a transport classification if you're doing a local delivery service. And the third related change that has happened is that this service has got notified under Section 9.5. And 9.5 means that if you are providing this through an e-commerce operator, then you have to offer this to tax, and the e-com operator will be liable to pay the tax. So if I then take a few examples, if you look at food delivery or you look at any of the local transport service providers that you're using, they if they are transport, then they could have taken a goods transport agency argument, which can get impacted. If they were local food delivery, those incomes were possibly belonging to the delivery persons and not really to the platform. But now that it's brought under ECO, it may come up to tax. So this is definitely a significant change, and we'll have to see more details of what circulars and clarifications that come in addition to this. And finally, Jayashree, a small change, but I will just quickly mention is the specified premises. This is more clarificatory. It's essentially saying that the option of 18% with ITC is available only if you are a restaurant in a hotel where having a room tariff of 7,500 plus or any room, and therefore others cannot take this rate. Others have to stick to 5% with their ITC. So it's more an explanation. It was clear, but there was some room for interpretation. So they've clarified their intent by this change.
Thanks, Devesh. I think there are quite a few questions on whether the insurance exemption covers group insurance policies that corporates take. I did hear you mention that this is only for individuals, and tax will continue to apply on group policies. Yes, please go ahead.
Yeah, I think I'd like to clarify there that what determines a contract of insurance is the policy. Okay, and that policy will determine who is the client. In case of group policies which are for the group itself, so if EY takes a health insurance policy for all EY employees, then that is exempted. But if you're using the group as a platform, the example that I gave of NBFC selling credit life, where the NBFC is helping the insurance company reach a large ocean of borrowers and selling term policies to them. The important point to see is how is the policy issued. In many of these situations, the NBFC is a master policy holder and the borrower gets a certificate of insurance. The certificate of insurance is the contract of insurance. And therefore, legally, insurance services are being provided directly to the borrower and not to the NBFC. So that distinction has to be appreciated. Similarly, if you have a EY health policy for all employees and you do top-ups on top of it, again, insurance companies typically issue a certificate of insurance in favor of the employee. And to that extent, even top-up policies will get come into scrutiny. So these aspects need to be examined and decided upon. But yes, very important question.
Sure. Thanks for clarifying that. So Sagar, let me come to you now. I think, across sectors, particularly with respect to goods, we discussed the fact that there's a lot of rationalization that has happened. Quite a few sectors are going to see a rate reduction and significant ones. There are a lot of transitional issues I'm sure businesses need to kind of gear up for, be it planning of the inventory costs associated with that. There are also questions on anti-profiteering. While there's been no announcement as such on anti-profiteering, I think $1 million question is, do we still need to look at passing on the benefit of rate reduction to customers? while they may not be a specific announcement to that effect. So let's get you in here for your thoughts on some of what are these transitional issues, which could pan across sectors. Some could be sector specific, but please do help us cover the same.
Sure, Jayashree, and thank you and good afternoon, everyone. So, as I see a lot of questions also on this, probably many of you would have by now known what is the rate impact within your industry, whether it is auto, textile, pharma, textile. Uh, I mean, all the sectors that we are talking about. But I think the common question is around to say that what do we do now? And I think the largest question that comes to say that if the rate of tax for my product has gone down from say 12 to 5, or probably from what it was earlier to 28 to 18, what should I do in terms of saying what is the impact of the GST which is there lying in my stock? So the input tax credit which is there, number one. And let me start with that to say if this block credit is there where you're saying you have an input tax credit at a higher rate and say you're going to sell your goods after 22nd at a lower rate, what will happen to this credit? And I think this is a question which is coming to many. And I think the answer to that is clearly yes, you will be eligible to credit. There is no bar under the law to say that this will not be allowed. The question that comes next is to say that what if I'm not able to utilize that credit and that's going to pile up because probably I don't see a manner in which I'll be able to liquidate that. I think the answer to that, unfortunately, is that there is no refund mechanism directly for those goods because what you're doing is more look at your finished goods which are lying in your stock, which were at 28 and now you're selling at 18. While it can be a working capital gap, but there is no direct refund mechanism for that. And we'll talk of some of those things, what is happening around it. But I know this is a question which comes to many, and the fact is there is no refund at this point in time. We'll talk of inverted duty refund separately, but that's the first point. Look at what is happening between, say, now 4th of September to 22nd of September. What happens to movement of goods that we are doing now? What will happen to say that if I'm selling goods now, supplying from, say, a manufacturer selling to a distributor and a distributor to the retailer. So what will typically happen is to say if you supply goods today, they are going to go at the higher rate, say it's 28%. And if these goods are going to lie in stock at the distributor or from the distributor to the retailer, and they're going to be sold after 22nd, if they're going to sold at a lower rate, this would obviously create blockage of credit. And as we know that in most of the industries today, everyone is wary of this point and people are fearing to say, why should we have this blockage of credit? So this is clearly one thing which is happening. And this problem is aggravated in some of the industries like auto or the non-alcoholic beverages, where there's an incremental compensation cess issue which is there. And let me just tell you what happens in those cases to say if the compensation says, and as we know, it's not going to continue beyond the 22nd September. What would really happen is that whatever remains in balance, and earlier also the cess credit was allowed only on the output side against cess, which means that whatever cess is there in the books of in the returns which is being filed by say a car dealer or the OEM as the case may be for the stock transfers which are done, all this cess is going to get blocked. In fact, if you see the way the provision is, and there is one risk in terms of how the interpretation is, if you see if this is treated as an exemption from compensation cess, because if you see this is not going to continue for anything other than tobacco. But what it means is if for automobiles, the compensation cess does not continue and this is being treated as an exemption the way the notification 1/17 was, then there is a risk that as on 22nd September, you will have to reverse this entire credit as per provisions of Section 18(4). So this is clearly a big issue which is there for auto industry and some of the other industries, as I said, and obviously a representation there. And I think this is a clear advocacy matter that we need to look at. But in any case, other than compensation says as well, there is a issue on in terms of working capital gap, which needs to be resolved for all the companies. And this can be at any level. It can be at the factory, it can be at a distributor or the inventory location, or it can be at the retailer. The other thing which comes to our mind is to say that can we look at something like a sale on approval, which means that if the manufacturer knows that if I sell the goods to distributor today, probably this is not going to be sold in its entirety prior to 22nd September. So can the manufacturer enter into a contract to say this is a sale on approval whereby I send the goods on a delivery challan with a clear understanding that if you sell the goods that is the time when I'll invoice you. I think in the law that we are talking about, if the intent is clear to say that you are doing that as a sale on approval, it is possible to do it. Again, well, we'll have to look at the nuances, the ifs and buts of the contractual norms, the rates, etc. But if you do that, what it typically means is to say if you sell on approval, you are not raising an invoice today. You will raise an invoice only after 22nd of September. Thereby, you will raise the invoice at the newer rate. Another point which is being coming for many is that fixation of MRP. What will happen in case of goods which are lying at, say, inventory location or a distributor's place or at the factory which are finished goods? With and for many of the manufacturers where fixation of MRP is mandatory as per the Legal Metrology Act, there will be a downward revision of rates because the MRP will include the rate of GST, which is at 12%, which will go to 5%. Now, in such a case, whether you will have to relabel, whether to refix the stickers to say that the changing rate, or we can just do away with it. See, one looks at the Legal Metrology Act and especially Rule 6 and 18. The reading that comes out is to say that if there is a upward revision, which means there is going to be increase in the rate, that is the time you'll have to do it. In case of downward revision, and while this is a fine reading of how LMR is, in case of downward revision, as far as you are passing on the benefit to the customer to say you're not exceeding the MRP, it is possible to say that you may not need to fix the sticker again, need not relabel it. And if one goes back to 2017 when GST was implemented, there was a specific manner in which the entire anti-profiteering provisions were there and how it was done in a manner to say that you had to refix because you had to show that you have revised your price, and also a possibility of saying you are giving a newspaper advertisement to say this is how we have revised it. In the today's scenario when anti-profiting provisions are not there, I think what is mandatory, more than mandatory, what is recommendatory is to say that as far as you are passing on that benefit in terms of ensuring that the price that you are giving on the invoice is lesser than the MRP, I think that should be a sufficient compliance of the law which is there. Let me come to the other point on reversal of ITC, and I think this is going to be very interesting. So if you see how the provisions are, in case if your goods or services are exempted on 22nd, and we have seen many of such cases where they have gone to nil rate or exempted, then whatever credit balance you have on 21st, you will have to reverse that entire credit is what the provision is. Now take a case where, and Devesh was referring to the hospitality sector, and let me take that example to say that if the room rate is less than 7,500 rupees, you have to now mandatorily go under the 5% scheme where you charge 5% GST, and you can't claim ITC. So it is 5% GST, no ITC. Now, in such a case, if I have credit balance which is there as on 21st of September, am I required to reverse that entire credit? Or I can take a stand to say that as on 21st, that credit was eligible, so that whatever tax payment I pay ahead after 22nd at 5%, I will still be able to use the old credit. I will not be allowed to avail and utilize credit after 22nd September, but prior to that, I can avail and utilize. Whatever I've availed, I can utilize. And I think if you see the way the provision is, and again, I'm referring to section 18(4), it talks about reversal of input tax credit on inputs and capital goods only and only in cases when the goods are exempted, right? So this is the case where the goods are not exempted. The rate has been brought down to 5%. So unless the lawmakers make a specific provision to not allow you, I think it's a fit case to say that you can continue using the ITC, which has been availed till that point in time. It's an interesting point to see how we're going to look at this and how department is going to really look at that. But I think if you see the old era, the Senmat credit regime, and there have been similar litigation in this manner. And I think the courts have held to say in such cases, if the credit was eligible on that day, then it can be eligible even later on. So let's see what happens on that. Let me come to the last point on transition.
Just to maybe build on that a little bit. Therefore, as a consequence, what we are saying is even if the credit pertained to the period, let's say today, but we are receiving those invoices after the credit becomes restricted on account of the lower rate without credit or an exemption, then we lose the chance to take the credit, right? As a consequence of what you're saying. So it's perhaps,
Yes.
important to try and see how we can claim credits pertaining to the business that is today taxable, which could get restricted at a later point of time. I think that's the incremental point I wanted to make.
Absolutely, Jayashree, absolutely bang on. I think it's very important to see how you're going to get all those invoices, which are in relation to uh, where your credit is eligible and towards taxable, where you're allowed ITC. I think absolutely right. So let me come to the last point on transition, and I think again extremely important is to say what is the rate applicable for goods and services in case of supply which has happened before the rate change or advances which are received before the rate change. I think it comes pretty clear if you look at you know how this is going to happen, and Section 14 of the CGST Act defines how this has to be done. But let me tell you that the FAQs which have been issued right now on this particular point, and especially I'm referring to FAQ number 4, there is one thing, one anomaly, if I can point out, to say that in cases where, say, you have received advance for goods and the invoice is going to be raised after 22nd. In such a case, basis notification 66/2017, the rate which has to be applied is the rate which will be the new rate. However, I think in the FAQ, it is saying that it will be the rate which is there on the date of advance. But we clearly believe that that's probably not the right position. I think while the FAQs were drafted, there has been a miss out on the notification which was issued, whereby the taxes on goods are not required to be paid on advances. So that's one point I really wanted to just highlight on that particular issue. Let me come to the another important point on inverted duty and a lot of questions around that. And I think let me start with that thing where everyone wants to ask to say, what if I have credit accumulated at 28% and now I'm going to sell goods at 18%? Will I be able to claim refund? And if you see on this point, there are two things which really impact. If you see the inverted duty refund entire provisions, the inverted duty refund is allowed to say, take a case where you have inputs, you are actually a manufacturer, you are processing and you are selling goods. And there's an inversion because all your inputs, raw material are at a higher rate and your output is at a lower rate. In a case where you're saying that merely because there is a change in rate which has happened on the product, you are looking at a scenario whether you will be eligible to claim inverted duty refund. Unfortunately, basis the way the provision of Section 54 and especially read with the circular, I think this is not going to be possible at this point in time. Clearly a point for advocacy to say that this might be an issue for a lot of players to say there is going to be a huge accumulation, probably no chance of recovery of such credit which may happen. Uh, in some cases, it may happen that because of the margins, because of the timing issues, you may be able to get it over a period of time. But in many cases, it can happen that this can get blocked. So this is one issue that we'll have to relook at. The other issue I wanted to highlight, and if you see what has happened really positive on the entire inversion is for many of the sectors like textile, fertilizers, if you see there was a huge inversion because of the fact that the inputs were at a higher rate. But if you see textile, and our honorable finance minister did say that we are talking of fiber neutrality, which means that even your fiber, your fabrics, your yarn has also gone down to 5%. Thereby, the probability of inversion has gone down drastically. You will still have some accessories, some buttons, some packing material. And again, let me tell you on packing material, we felt that everything has gone down to 5, but probably what has gone down is only some corrugated boxes and paper related packaging, but probably your plastic has not gone down. So there will still be some inversion which is there, but I believe it will go down drastically. What's really going to affect is your capex, the ITC input as credit on your capital goods. And I think that's going to be a huge cost. I think it's going to be important for the industry to really have a look at to say, does it make sense now to capitalize that input as credit in relation to capital goods and rather than expensing it out and trying to retain it to say that you may probably get the credit or rather benefit by claiming depreciation under the Income Tax Act. So that's going to be an interesting play in terms of what one would have to really look at. I think one of the other sectors which has really got impacted on this, again, pharma, it's going to continue, the inversion will continue. It's not going to go down. Renewables, and I think that's also in the FAQ, somewhere it's coming out to say that the inversion may continue to grow. I think one very important thing which has happened and probably not something which has been thought of, but it just happened. If you see what has happened is the rate of ammonia has gone down to 5%. And if you see in the current scheme of things where there's a lot of push on green hydrogen and green ammonia, a manufacturer of green ammonia is going to end up now accumulating far more credit. The probable intent was to benefit the fertilizers company to say that the ammonia rate going at 5 will reduce their inversion, but that's going to create a huge blockage of credit for companies who are investing huge amounts of money for manufacturing green ammonia. Not only that, let me tell you that this is also impacting the incentives. And if you see many of the states who are actually providing state incentives, which are linked to GST, whenever the rate goes down, say from 12 to 5, and if the incentive of state is linked to 2.5% of the state GST, and if it is net GST provision, in most of the cases, companies are not going to get the GST incentive. So that's another thing which is there. Same would happen to some of the companies who have plants in Northeast like Sikkim. A lot of pharma companies have plants there, where the budgetary support which is given, if it was at 12% rate and there was a net cash outflow, they would have got a refund. But at 5%, probably there won't be much. So there are going to be some losses in terms of some of these incentives which are there. And I think the government will have to come together to compensate by saying, provide a beneficial mechanism in terms of direct capital subsidy rather than linking it to GST. Quickly, let me talk of post-sale discounts since Vipin and Jayashree spoke of it. Let me only talk of 2 or 3 critical points. I think the omission is a great move because this entire requirement of establishing the link between the pre-sale agreement and the post-sale supply discount, which will reduce a lot of litigation. But I think there are 2, 3 critical things which are there. So one is the good thing is that the post-sale discount rules and the linking with the credit notes to the invoice is also being done away with, which is a great thing. There are 2 or 3 very important issues that we need to look at. Number one is to say that will this apply to credit notes which are given for sales which happened prior to 22nd? I mean, again,